The latest on the Secure Act. Remember back before the COVID pandemic, there was this big piece of legislation that passed through Washington that was probably one of the most sweeping changes to retirement accounts that we've seen in many, many years. Sort of has gotten lost in the shuffle now. Last week, the IRS issued out some guidance on some of the more intricate parts of the act. So we thought it would be good to kind of bring that one back and talk about its impact in case you had forgotten that amidst all of this COVID and, of course, election stuff, right? Times of great uncertainty. You got an election coming up in 9 days from now. We thought also it would be good to remind folks of some of the fundamental rules of investing that exist no matter whether we're in a presidential election year or not. So all that on the show. Welcome, of course, to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you on Sunday mornings here on News Radio Orlando Network, along with 96.9 The Game. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web. Over 13,000 downloads of our program, thanks to the accolade we got at the beginning of the year, naming us one of those top 25 financial planning podcasts on the World Wide Web. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this very week to help you change your life with a successful and cost-effective financial plan that produces superior investment results and provides you with peace of mind for the future. So before we get to the Secure Act and some of those fundamental rules of investing, as if things can't get any worse these days, right? We got pandemic and we've got an election, and that's just so breaking families, really, in terms of just how polar opposites this election is making everybody. Well, to make matters worse, the scammers are out there, and they are exploiting the election and the emotions that come with this election, along with COVID, to gain your personal information and, more importantly, to take your money from you. The FBI, the Better Business Bureau, and cybersecurity experts have all recently warned of a significant increase in new and increasingly sophisticated online fraud schemes, with the goal to sort of work the headlines, work the emotions, and ultimately have you part with your money. The FBI alone reports that complaints to its cybercrime reporting site have increased by fourfold over the course of the start of the pandemic. And unlike crooks to take advantage of a tough situation and make it even tougher. So just beware. And in particular, watch for election-related spoofing. And what spoofing is it's the creation of a website that sort of looks like it's the website of the candidate, but it really isn't. Look for emails that say, oh my goodness, you've got to vote, or you've got to vote for this particular candidate, or else you'll need to pay a fine, or something like that. The reality is that you need to look carefully at this stuff. Particularly look for like misspellings or just slight alterations of an email. Maybe there's a .com at the end when there probably should be a .gov, considering that's a government-related type of email. So just be aware of that. The number one rule, you can't say this enough, the number one rule, and this was actually part of the cybersecurity training that we do at the office every month. Every member of the team has to take a course, lasts about 15 minutes, and you have to take a 30-question exam to make sure you're paying attention during the course of it. And this month's version of that obviously had to deal with phishing and these types of scams. And the number one takeaway that we wanted to share with our audience is that it's so important to independently verify whatever it is that you get, not just sort of verify through the email or through the record that you're getting, but really if it's a political campaign related email, go independently and search for that political campaign's website and go that way. Sort of independently verify. Don't just click on the links inside of that email, because they're going to direct you to the spoof email or the spoof website that they're about. So again, remember the number one rule when it comes to this stuff is make sure that you take some time and independently verify whatever it is that you're getting to make sure that you stay safe, particularly during times like this when the scams have really increased dramatically. On sort of a more positive note, right? Get away from the scammers. Here's the latest on the COVID medical progress. And this is really kind of interesting. There's at least, at last count, 213 vaccines in the works and 319 different treatments in development stage. And the good news is we just need one of those vaccines and one of those treatments to work. So the good news is that that is an ongoing process. The bad news, and certainly the things that we worry about, are the disproportionate economic impact on certain sectors and age groups in particular in the economy. We talked about this last week on the program and sort of talking about that K recovery that we're seeing out there in the markets, in the economy as a whole, not necessarily the markets, more the economy. And what that means is then that you've got almost this bi-directional recovery. If you've got one of those jobs that are more computer-based or tech-based, you're experiencing a continued improvement in your economic status. Meanwhile, if you're in those sectors like leisure, service, travel, things like that, you're probably not seeing that at all. And so consequently, you've got sort of two directions that are occurring out there in the economy at large. And to further sort of remind myself of that, this just past week, again, we saw more folks from Disney dealing with the reality of what happens when certain sectors of the economy basically are shut down. And so it's a lot to comprehend. Taking a minute to talk directly to those folks at Disney that have been directly impacted by this. It's certainly a lot to comprehend, and know that we are here to help guide you with those decisions, because there's an awful lot of decisions that need to be made. And at the end of the day, it's a highly emotional and difficult situation. And as we said last week, look, we find greater purpose in helping people, guiding them, than whatever may come from a business perspective. That's why we don't have minimums. That's why we don't charge for consultations. And that's why you're not required to set up an account with us when you just want to seek our guidance. In our opinion, it's more important that you come in, visit with us, and that we help you and you leave, rather than stay and become a client and not have us add any value. So certainly something to think about there. We're going to take a break. When we get back, we will continue the conversation about the Secure Act here on Dollars and Cents. So the IRS recently issued some guidance on the Secure Act. Remember that bill that passed back in January? It was probably one of the most sweeping pieces of legislation that affects your retirement and your retirement accounts that we've seen in years, if not decades, and sort of has gotten lost in the shuffle of the COVID pandemic and the presidential election. But it's got some pretty significant impacts. And this past week, the IRS issued some guidance. So we want to take a moment and sort of unpack some pieces of the Secure Act that maybe you have forgotten. So welcome back to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. Central Florida's longest running radio program, coming to you every Sunday morning on News Radio Orlando Network, along with 96.9 The Game. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web, with now over 13,000 downloads of our program. To find us on social media, if you'd like to subscribe to any of our channels, we're on pretty much everywhere, whether it's Spotify, iTunes, Facebook, YouTube, you name it, we're there. Just go to our website, Nelson Financial Planning. You'll see a bunch of icons in the upper right-hand corner. Click on one of those and you'll get directly connected. My name, of course, is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this very week to help you change your life with a successful and cost-effective financial plan that produces superior investment results and provides you with peace of mind for the future. So before COVID, back in, I guess, normal times, the folks in Washington passed a pretty significant piece of legislation in January that had some pretty widespread implications on your retirement and your retirement accounts. And so in the midst of COVID and presidential election, it's sort of gotten forgotten. IRS issued out some guidance this past week on some of the intricacies of the Secure Act. And so we wanted to hit some of those highlights because they do have some pretty profound impacts on your options when it comes to retirement accounts, and in particular, the options that your beneficiaries are going to have when it comes to them inheriting those accounts. So first and foremost, one of the things that the Secure Act did was it allowed you to make IRA contributions if you are over the age of 70 and a half. Previously, not able to make those contributions once you pass 70 and a half, because at 70 and a half, that meant that you had to start taking out required minimum distributions. Well, lo and behold, not only did they change the required minimum distribution age to 72, but they also said if you are still working, remember, that's the caveat, if you're still working, because if you're not working, you're not earning money, I don't care what age you are, you're not going to be able to contribute to a retirement account. You must have earned income. For those over age 70 and a half that are still working, previously they didn't have the option to shelter in a IRA or a Roth unless their employer offered that option. Now they have that option and the ability to do it on their own individual basis. So make sure, though, that your custodian of your retirement account is, in fact, accepting those contributions. Technically, they are not required to accept those contributions until after December 31 of 2022. I would be surprised if there's custodians that don't take those contributions, but just make sure and double check with your IRA custodian that, yes, in fact, they will take those contributions. So right out the gate, that's a pretty significant change that allows you, if you're still working and you're over 70 and a half, to actually make a contribution to a retirement account. Number two, the contribution, though, does not reduce your required minimum distribution. Here's where the IRS guidance that they recently issued out was specifically focused on. It's kind of a little weird and odd when you think about it, but the point is that you don't get to make a contribution and then use that to then ultimately reduce down what your required minimum distribution was. It really to be viewed as separate transactions in that account. So you've got your required minimum distribution, and then you can also make your contribution. I'll give you an example. So let's say you're age 74, you've got a required minimum distribution for the year 2021 that's $30,000. You make a $7,000 IRA contribution because you happen to still be working. Your RMD, your required minimum distribution, is still going to remain as $30,000. So just know that while on the tax return they do kind of sort of wash themselves out, right? If I get a $30,000 required minimum distribution, I'm going to have ordinary income of that $30,000. If I do a $7,000 in an IRA, then that's going to be a tax deduction. So ultimately they sort of net out to 23, but that's really a tax return transaction. That's not a transaction inside of your IRA. So you could be like, oh, well, I'm just going to take $23,000 of a required minimum distribution if my required minimum distribution is 30 because I was going to do a $7,000, IRA contribution. You can't do that. You got to take the 30 and then turn around and put the 7 in separately. So kind of a little weird there, but ultimately it washes itself out on the tax return. But bottom line is based upon the IRS guidance, you've got to respect both transactions as separate transaction, RMD, IRA contribution. The next piece of guidance that was issued by the IRS on the Secure Act has to deal with this QCD, this qualified charitable distribution. This is a very powerful technique that we've talked many times before on the program that basically allows you to take your required minimum distribution and send it directly to the charity of your choice. And then that means that that portion that you sent to the charity isn't included as part of your required minimum distribution. So this one's sort of the opposite of what we just said about being able to make contributions and how you have to do that, take out the full amount of the required minimum distribution, and then put in the IRA contribution. On a qualified charitable distribution, you had to report the full amount of the RMD, but the taxable amount was then subsequently reduced by that qualified charitable distribution. So the IRS created this kind of really complicated formula that basically reduces your qualified charitable distribution amounts by the amount of the IRA contributions made past 70 and a half. So it's kind of an odd formula, if you will. I think the applicability comes into play if you are giving all of your required minimum distribution away as a qualified charitable distribution. If it's only a part, then at the end of the day, that should be fine. But know that there's a calculation that you now have to make sort of behind the scenes on that qualified charitable distribution if you are making IRA contributions after the age of 70 and a half. So next up, they also eliminated the Secure Act also eliminated a 10% penalty exemption, or created a 10% penalty exemption for births, adoptions. So what that means is that you're allowed to take $5,000 out of a retirement account per child, per parent, and not have to pay a 10% penalty if you are under age 59 and a half. So as you know, when it comes to a retirement account, there's a series of exceptions to what would normally be an early withdrawal penalty. This is now a new one that has to deal with the birth of a child or adoption, allows you to take up to $5,000 and not have to pay a 10% penalty. So you're gonna pay taxes on it, but won't have to pay the 10% penalty on it. That would typically apply if you're pulling that money under age 59 and a half. And then lastly, and here's the really big change when it comes to the Secure Act, and that is the elimination of the Stretch IRA. What the Stretch IRA does is if you pass, your kids, your grandkids inherit your retirement account. They had previously the ability to spread that out over the course of the rest of their lifetime. That's pretty powerful stuff. The Secure Act eliminated all of that and ultimately limited beneficiaries to have to take out the money over the course of a 10-year period of time. Folks, that is a massive tax increase to your beneficiaries. And just one example, we did a call this past week with our clients talking about the election and Democrats and Republicans and things like that. And this notion that it's Democrats that raise taxes and it's Republicans that lower taxes. Here's a good example of a situation where the Republicans actually raise taxes pretty significantly when it comes to the beneficiaries of your retirement account. Because folks, there's a big difference in the tax implications of being able to take something out over the course of 50 years and pay the taxes on it over 50 years versus 10. So be aware that if you've got an estate plan that took advantage of the Stretch IRA, that option not available, you may need to go back and revise your estate documents. So with that, we will shift to a break. We come back from the break, we're going to talk about some of those fundamentals of investing that are always good to remember, particularly during uncertain times. Coming up next here on Dollars and Cents. You often hear us say on this show there are some fundamentals of investing, some truisms, if you will, that exist no matter what, whether it's a presidential election year, whether it's a pandemic, whatever the case may be. There's just some fundamental investment truisms that exist. And so we wanted to share with you today some of those and also talk about them from a historical perspective. Happened upon an article that is actually 27 years old that really helped to underscore those investment truisms. And so we wanted to particularly share those with you on the program today. So welcome back to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. Central Florida's longest running radio program, coming to you on Sunday mornings on the News Radio WFLA Orlando network, along with 96.9 The Game. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web, thanks to an accolade bestowed on us by the folks at FeedSpot at the beginning of this year. Our podcast now over 13,000 downloads. So be sure to subscribe to us on your favorite social media podcast channel of choice. Just simply look for us under Nelson Financial Planning, Dollars and Cents with Joel Garris. And of course, that means that I'm Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful and cost-effective financial plan that provides you with superior investment results over time and peace of mind for the future. So I happened upon this article entitled The 16 Rules of Investment Success. And while we're not going to go into all 16 rules, after all, it's only an hour show, the reality is that we wanted to take some time and sort of hit some of those rules to recap them, particularly now during, of course, a highly emotionally period of time, whether it's COVID and then the combination of the election. We just think it's a bad combination, if you will. And certainly, if you look at some of the mental health statistics out there these days, it's not good at all. The latest statistic that I heard from the Central Florida Mental Health Hotline is that their call volume has increased by threefold over the course of the past 6 months. So pretty dramatic. A lot of people struggling with what's going on out there in the world at large. And so what's really interesting about this article that we saw is that these 16 rules were written by a gentleman by the name of Sir John Templeton. Now, Sir John has long passed in 2008. He was a pioneer in the financial services industry, and this article that he wrote about these 16 rules was actually written in 1993, over 27 years ago. And that's kind of the start of the story, or should we say the point of the story. Whether it's 1993 or 2020, just some fundamental rules that exist out there about investing that you should follow no matter what. So here goes a few of them, if you will, to help remind us of what it takes to be a successful investor, whether it's 1993 when this article was originally published, whether it's 2020, or whether it's 2040. We'll still be here on the air generating it probably would be different. It's different now, right? Because now I'm doing the show remotely and not in the studio, but hey, with the magic of technology, we will carry on just as we always have. So here we go. Some of the rules for long-term investing success, some of the truisms. Number one, invest for maximum total real return. Invest for maximum total real return. Now, what the heck does that mean? Well, it means that you got to take into account inflation and taxes. Maximum total real meaning real, that's money that I get to spend. So that means you've got to account for inflation. You must protect your purchasing power. The reality is that inflation, whether it's 1%, 2%, 3%, it has an impact on your ability to spend money over the course of your retirement. Now, right now, maybe not as big of an issue because we're living in low interest, low inflation rate environment, but certainly there are times when inflation has come about. And if you're looking at healthcare costs, inflation is still very much there and very, very rampant. So this is a particularly big issue to be mindful of now when interest rates are as low as they are, right? Because if you've got money sitting in cash or in a bond, you're not making hardly anything on it. You're not even keeping up with inflation. based upon the current rates that savings accounts, checking accounts, money market accounts pay. So the point is, invest for maximum total real return. You've got to look at inflation. You've got to look at taxes, of course. Low rates now, but with all of this COVID borrowing, this COVID spending, probably going to see them higher. So invest for maximum total real return. That means you're taking into account inflation, taking into account taxes, and you're making sure that your investment allocation is not in asset classes that are only generating returns that are less than inflation and less than taxes. So you got to watch out for that. Number two, invest, don't trade or speculate. The stock market is not a casino. If you treat it like that, then that is what it is. Then that's what you are doing. You are trading, you are speculating, you are not investing. If you can't easily articulate what you own and why you own it, for example, I own this particular fund or this particular stock because this particular fund has had a track record and well diversified of large companies, or I own this particular company because it's on 90% of the computers in the world or something like that. If you can't clearly articulate that, what you own and why you own it, forget it. You shouldn't be owning it. There's so many different trading strategies out there, so many different investment products out there that the confusion among investors is incredibly, incredibly high. So simplify it. It works well in life. It works well with your investments. Make sure that you are an investor, not a trader. Number three, probably even more important, ignore the crowd. The crowd's always late. By the time the media start reporting about a hot stock or a hot asset class or a hot sector, well, the performance will have already happened. So at the same point in time, I guess there's another corollary to that, right? Buy low. The crowd will not be buying low. The crowd will have driven the price up and be buying high by the time you do it. So ignore the crowd when it comes to investing. And fourth, diversify, right? I mean, don't have all your eggs in one basket. We talked about this earlier on earlier shows, where one of the things that's happening right now is you've got a small handful of companies that are driving a large portion of the overall market. Okay, if you look at the FANGs and their role in the S&P 500 and how much that small handful of stocks are driving the overall performance of the market, you'll come very quickly to the conclusion of, wow, well, that's not very diversified for an index that's supposed to be 500 companies to have 5 companies or 10 companies drive close to a third of the overall performance. How diversified is that at the end of the day? So no matter how careful, you're not going to be able to predict the future in terms of a particular sector or a particular company. So that's the concept of diversification. Make sure that you have all of your bases covered. That also means, though, that at any given point in time, not everything will be going in the same direction. And that's okay, because that's what you want. That's the nature of diversification, is that if the market's going down, you should certainly have parts of your portfolio that aren't. When the market's going up, maybe those parts that don't go down when the market goes down aren't maybe going up as much. So that's the trade-off, but that's the importance of why you should be as diversified as you are. And number 5, and this is a very popular one, don't panic. This time is different are the 4 most costly words in the investment language. Those are the 4 most costly words to an investor. This time is different. This time is different. So I'm going to make significant changes to my portfolio because this time is different. Those are the 4 most costly words for an investor to utter. So remember, that's just 5 of the 16 rules for investment success that were written by Sir John Templeton in 1993. Boy, they're still applicable today, just as they ever were. So hopefully we we're able to give you some perspective on those rules, those truisms, and remember the fundamentals of investing success never change. With that, we'll take a break and return after these messages here on Dollars and Cents with Joel Garris. So we're talking in the prior segment about the need to diversify. I'll give you the statistic that when we look at, we kind of say, this is a market that might be getting concentrated in a small handful of companies. So don't know if you're aware of how dramatic those numbers are getting, but if you look at the S&P 500, which is obviously intended to be an index of 500 companies, what you'll find is that it's just 10 stocks, so 2% of the 500, that accounts for almost a third of the overall performance of that index. So why does that happen? Well, we'll explain that next on Dollars and Cents. Welcome back, of course, to our program where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you here on Sunday mornings, News Radio Orlando Network, along with 96.9 The Game. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web, with over 13,000 downloads of our program on various channels, whether it be iTunes, Spotify, YouTube, whatever the case may be. We're there. Check us out. Make sure you subscribe. Simply search for Nelson Financial Planning or Dollars and Cents with Joel Garris. My name, of course, then is Joel Garris, certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciary stands ready this week to help you change your life with a successful and cost-effective financial plan that produces superior investment results and provides you with peace of mind for the future. So S&P 500, right? 500 different stocks, but that's not how it works. See, the S&P 500 is a weighted average, a weighted index. So that means that the bigger you are, the more you account for the performance of the index. And so today we're seeing sort of a split, if you will, where a very small handful of companies are driving a tremendous amount of the performance. The statistic we were giving earlier, you've got 2% of the companies in that index driving nearly a third of the performance of the index. Folks, that speaks to a lack of diversification. The last time we saw statistics similar to that, it was 1999. And if you don't recall what happened in 2000, 2001, it did not end well. So be aware when we talk about diversification, it's not just enough to be like, oh yeah, I own an index fund or whatever the case may be. You've really got to dig deeper and see, okay, well, what amount of my portfolio is constituted in my top 10 holdings? Folks, if that's getting to over 30%, that really speaks to not being as diversified as you should be. Your top 10 holdings in any portfolio should never be breaking above 20%. If you own the S&P 500 index, then your top 10 holdings are accounting for over 30%. So be aware that this issue of diversification is one that is lurking in the background, particularly today, given the massive run-up of a small handful of companies, and we know them as the FANGs. If you're an investor, or you've maybe heard that label on in the media, it's the companies like Facebook and Amazon and Netflix and Google. Those are the FANGs, and throw an Apple in there as well, Microsoft, another one kind of in there. Those companies, Netflix, again, you know, they're the 8 or 10 companies that we all can kind of rattle off the top of our head. Those companies, though, are driving a significant portion of the market. So from a diversification point of view, make sure that you are aware of the impact that they can have and the lack of diversification that they can bring to the table if you are not looking at your portfolio and drilling down and looking at what are my top 10 holdings inside my portfolio that ultimately show me what it is that I actually own. If you own a bunch of funds, the reality is that those bunch of funds may all own the same kinds of companies. So you got to drill down and really specifically look at the top 10 holdings. As we continue in this segment, I want to come back to a segment that we were doing in the last segment a couple of weeks ago. We sort of ran out of time, and it was some tax tricks for 2020. And so we talked about the notion of converting IRAs to Roths, and certainly looking to take advantage of that, particularly this year when interest rates are low. Not interest rates, tax rates are low. The reality is that there were two caveats that we want to make sure that folks understand. Number one, you've got to make sure that you've got ready funds available to pay for that. That is a taxable transaction that's going to appear on your taxes. And unlike in previous years, if you don't like the tax result, you can undo it. You can no longer undo a Roth conversion. A recharacterization, which is what it was called previously, no longer allowed. Similarly, beware the ripples, whether it's more of your Social Security get included as taxes, or whether it's losing the loss on a rental property. Understand that when you do a conversion, it's income, it's ordinary income, and that can have some pretty big ripple effects throughout your return. The other thing we talked about, qualified charitable distribution, great technique. If you've got a required minimum distribution and want to make gifts to charity directly, then that ultimately reduces down the amount of the required minimum distribution that you have to report on your taxes. Again, RMD suspended for the year 2020. You can still do a qualified charitable distribution though, so certainly something to think about between now and the end of the year. So other items that we sort of ran out of time on, one of which has to deal with gifting. And understand that you can gift someone up to $15,000 annually per person. So your spouse can give to your child and their spouse and their kid each of $15,000. So ultimately that means that you can obviously give a lot more money than you might have originally thought without any tax implications. No tax implications to you, no tax implications to the recipient, along with the fact that you can obviously give unlimited direct amounts for tuition and medical expenses. So the IRS has stated that there will be no clawback, but at the end of the day, the estate tax exemption at $11,580,000 per person is very much subject to change. So if there is some gifting and estate planning that you want to try and do, we would encourage you to do that between now and the end of the year, because starting next year, we may see those estate tax exemptions be dropped, and be dropped significantly. This conversation about reducing those down to 5 million, so 11 million down to 5 million, that's a pretty big change. And so the reality is that may very well happen. It's scheduled to happen regardless in the year 2025, because all of this is subject to phase outs. So it's going to happen. The question is whether it happens next year or whether in 2025. But certainly something to be thinking about between now and the end of the year as to whether you take advantage of those higher estate tax limitations and numbers. And then lastly, make sure you're updating your estate plan after the Secure Act. We talked about that a little bit on the program earlier. Secure Acts fundamentally changed the stretch IRA, so that really may mean that you need to adjust your amount of money or estate plan that relates to your IRA. So with that, we'll wrap it on up and get on out of here. Thanks for listening to the program here on Dollars and Cents. This is Joel Garris on News Radio WFLA Orlando.